Ladies and gentlemen, welcome back to another episode of Boss Economics World, where we uncover the hidden dynamics behind key global events and hold accountable those whose policies shape or break our economies. Buckle up because today, we're diving into one of the most heated and wide-reaching economic dramas of the year, the escalating trade tensions between the European Union and China over electric vehicles, EVs. Headlines might tell you this is just about tariffs, but don't be fooled. What we are actually witnessing here is a macroeconomic tug-of-war, with profound consequences far beyond the car industry. By approving tariffs as high as 45% on Chinese electric vehicles, the EU has set in motion a series of economic dominoes that, if mishandled, could send Europe further into economic malaise while intensifying the global trade war. And let's not forget, folks, that behind every tariff, there lies underlying issues of slow-growth economies, failed industrial strategies, and the political desperation of leaders like French President Emmanuel Macron trying to salvage what's left of Europe's competitiveness. To understand the significance of the EU's decision, we have to zoom out and look at two things: the bigger trend of global protectionism and the geopolitical chess game between dominant economies. Now, we've seen protectionist policies surge in recent years. Trump's America set the tone with its trade war against China, and the world took note. The EU, often seen as the bastion of free trade, has been caught between two giants, the United States and China, for years. But let's be real here, Europe is betting more on survival than victory. The tariffs on Chinese EVs represent a defensive maneuver, trying to shield the domestic car industry from the sheer competitive advantage that Chinese firms possess, largely thanks to their government-backed subsidies. But make no mistake, this isn't about EVs alone. This is about critical industries, technology leadership, and the long-term strategic threats posed by China's aggressive industrial policies. Whether it's batteries, solar panels, or rare earth metals needed for clean technologies, China has made steady advances to dominate sectors that represent the future of economic growth. The EU's new hardline stance actually mirrors how the US and other nations have tried to rein in China's influence. While the EU might frame this move as complying with WTO rules, it's essentially selecting industries where it feels uncompetitive but too important to fail. In other words, the EU is waging an economic battle to keep what remains of its technological and industrial relevance. Let's get down to business. The real reason behind these tariffs is that Europe's economic engine is sputtering. While policymakers in Brussels won't admit it, nationalism and populism are rising across the continent, due in large part to consistent economic underperformance. According to former European Central Bank President Mario Draghi, and this is key, folks, the EU has been lagging behind the US in productivity growth for 2 decades. Let that sink in. The gap between the US and the EU in terms of growth has widened, driven by lower investment in critical sectors like digitalization and technology, and a sluggish innovation ecosystem. Meanwhile, China pressed ahead with its state-backed capital, pouring billions into industries of the future. With its lightning-fast scaling of EV technology and dominance in the production of lithium-ion batteries, China now threatens to outcompete Europe right at the time the global north is trying to transition to cleaner economies. Even French President Emmanuel Macron admitted that Europe's economic model needs to be reset. No truer words have been spoken because, let's be honest, Europe is at a dangerous crossroads. With growth rates barely scraping by 0.5% to 1% GDP growth in many European economies, and inflation still lurking in the background, these tariffs on Chinese EVs are a side effect of European desperation trying to reclaim manufacturing sectors that might already be out of reach. Ladies and gentlemen, when the president of your country warns that your entire economic model is at risk, you know things aren't going well. So, if Europe doesn't reset its approach, the bloc could be caught between two competing superpowers, the US and China, ending up more as a casualty of their tug-of-war rather than an influential force. Let's dive into the auto sector, where Europe has traditionally been a world leader. What's the motivation behind slapping up to 45% tariffs on Chinese EVs? Unsurprisingly, European carmakers, from Volkswagen to Mercedes-Benz, are feeling the heat. Just take a look at the latest numbers. Between 2019 and today, China's share of the global EV market ballooned to just shy of 58%. In Europe, Chinese automakers accounted for around 8% of new EV sales in 2023, a number poised to rise if action hadn't been taken. Volkswagen, Mercedes-Benz, BMW, and Stellantis, all of them were hit by waning relevance in the Chinese market, and even broader losses globally. VW is considering closing plants right within Germany. Stellantis has seen such lackluster sales in the US that they issued profit warnings in the past few months. The shift of global capital into EVs wasn't something Europe anticipated well because it placed too many of its bets on diesel cars and internal combustion engines. China, on the other hand, leveraged its substantial state support to catapult itself into a leading position in new, sustainable technologies, be it batteries or electric vehicle components. So the real question is, will these tariffs offer Europe's auto industry the reprieve it needs? Short term, sure. But long term? That's a different question. While the tariff hike might provide protection to European automakers from an onslaught of cheaper Chinese alternatives flooding European showrooms, it does nothing to solve the underlying issues of Europe's diminishing global competitiveness, especially in high-tech industries. Tariffs work like financial band-aids. They hide the wound, but don't heal it. Here comes the twist, folks. The inherent risk in any trade war, and this is especially true with China, is that retaliation is almost always immediate, and the consequences will boomerang right back at European consumers and businesses. China has already made it clear it's not going to take this passive-aggressively. In response, Beijing is threatening to slap punitive tariffs on essential European imports like dairy products, brandy, pork, and, yes, European cars. These are industries where many EU members, particularly Germany, Spain, and France, have significant export stakes. Consider what fate lays in store for German automakers if they lose their crucial Chinese market further. Volkswagen and BMW have already faced setbacks in China, and any form of a targeted tariff on exports to China will only deepen their woes. We have some fresh numbers as well. In 2022, Europe exported over €217 billion worth of goods to China. Losing even a percentage of that directly impacts jobs and profits across the continent. China, the world's largest car market, imported over 1.8 million vehicles in 2022, many of which come from European factories. A tit-for-tat tariff war will not only damage the auto sector, but will significantly cut into export revenues just when Europe is dealing with historically high inflation. That brings us to another critical point: inflation and the unresolved struggles of the European economy. Now, the cherry on top of all of this, inflation. EU policymakers are already grappling with the effects of an inflationary shock still rattling their economic systems. Coming suddenly off the pandemic-related fiscal boost and the energy price crisis exacerbated by the Russia-Ukraine conflict, inflation has eaten into people's savings and forced the European Central Bank to take aggressive rate hikes over the past 2 years. The imposition of tariffs, essentially protectionist measures designed to keep out lower-cost Chinese EVs, has a sneaky way of trickling down to consumer prices. The tariffs increase production costs for European automakers and leave them with a choice: either absorb the financial hit or pass those costs onto their consumers. We all know which option they'll pick. That's right, higher prices for cars, especially EVs, which the EU is desperately trying to push for climate-related goals. If consumers, already struggling from high housing, energy, and living costs, face even higher prices for EVs, the transition to green technology may be stalled even further. Is that really the best way to fight climate change? EU policymakers, driven by immediate fears of industrial collapse, are now playing a dangerous game with China. Even German Economic Minister Robert Habeck acknowledged the need for a level and fair playing field, but he just as quickly warned against full-blown trade wars that would cripple Europe's economy and lead to painful consequences for everyday consumers. Let's not forget that we live in a deeply interconnected world. You can't just slap tariffs on China and expect no blowback. The World Bank warned just last August that protectionist policies not only constrict trade flows but fuel inflation by increasing the cost of goods due to supply chain disruptions. The longer these barriers remain in place, the stronger the potential for more significant cost-push inflation that will inflict pain on average European households. In the grand scheme of things, the EU's much-needed economic competitiveness overhaul goes far beyond tariffs. Leaders like Mario Draghi warned of the potential slow agony facing Europe if it doesn't invest in its transition to future technologies. A band-aid of tariffs might help stem the flood for now, but larger existential questions loom large, especially as Europe faces mounting global challenges. The tariffs on Chinese electric vehicles might seem like a quick fix, but Europe requires a strategy that fundamentally evolves its economic structure to survive and prosper in an increasingly competitive world. Now, let's unpack the 3 crucial long-term risks Europe faces if it doesn't address its deeper, structural problems and instead leans too heavily on short-term protectionist solutions. 1. Global trade fragmentation and protectionism. A race to the bottom? We already mentioned the risk of this escalating into a full-on trade war, but the long-term danger is even more profound: the steady global march towards trade fragmentation. Historically, the EU has benefited immensely from being a major player in a multilateral trading system. Almost 50% of Europe's GDP is tied to international trade, a figure that surpasses that of the United States, where trade accounts for only 20 to 25% of GDP. The moment Europe becomes too embedded in trade wars, it risks allowing trade dependency to shift elsewhere. Remember, we live in a multipolar world. If Europe continues to stand between two juggernauts, the United States and China, while alienating both, global trading partners could simply reorient their flows towards emerging markets like Southeast Asia and Latin America. Trade would then bypass Brussels and move towards hubs with fewer barriers. In fact, China has already hedged its bets by establishing stronger commercial ties all over Asia, Africa, and Latin America through bilateral and multilateral trade agreements. For example, the Regional Comprehensive Economic Partnership, RCEP, which includes powerhouse economies like Japan, South Korea, and Australia. If Europe becomes overly hostile to Chinese imports, Beijing has alternative partners at the ready, tipping the balance of global trade connections further away from Europe. And Europe isn't the only region aligning defensive policies against China. Our friends in the United States have already placed heavy tariffs on Chinese goods, and trade fragmentation is gradually increasing across the board. This is also where Europe stands to lose further, by potentially finding itself outmaneuvered by the US, which is rapidly reshoring and reshuffling its supply chains through the Inflation Reduction Act, IRA, and strategic investments in semiconductor production and critical infrastructure. 2. Technological lag. Is Europe missing the next industrial revolution? While Europe has long been home to industrial giants, think Volkswagen, Airbus, and Siemens, its technological foundation is beginning to crumble under the weight of outdated practices and underinvestment in future industries. As noted by Mario Draghi last month, Europe faces a slow agony if it cannot decisively shift from collaring legacy technologies to pivot into the fourth industrial revolution. There are several sectors where Europe is already falling behind. Digital technology. Despite some movement in the field of AI or 5G, Europe has failed to take the lead in global technology innovation. According to the European Investment Bank, Europe accounts for just 12% of global digital platform revenue, compared to 80% from American and Asian companies. Clean energy technology. China is by far ahead of Europe in producing the batteries required for EVs and in manufacturing solar panels, wind turbines, and other renewable energy systems. Chinese companies already supply over 43% of global EV batteries, with giants like CATL, BYD, and Ganfeng Lithium in the lead. Tech and venture capital. Europe's funding ecosystem is considerably weaker than its peers. Venture capital investments in European tech startups, for example, trail behind the booming ecosystems in the US and China. In 2022, US startups secured over $200 billion in venture funds, while their European counterparts only managed around 86 billion euros. If the continent doesn't rapidly catch up, the tariffs on Chinese EVs are just going to delay what is already inevitable: a future in which Europe's industrial base shrinks and other markets become tech leaders. This technological lag also hinders Europe's ability to extract value from the next big economic transformations, from artificial intelligence, Internet of Things, IoT, and big data to clean energy technologies that are essential for combating climate change. Without sufficient investment or a coherent European strategy in these rapidly developing sectors, the continent risks falling irreversibly behind, not just China but also the US and other tech-savvy regions like Southeast Asia. 3. The political paradox, a fractured Europe, rising populism. This is where the economics turn undeniably political. How exactly will European leaders cope with the potential domestic fallout from any retaliatory moves by China, rising price inflation, and strained manufacturing industries? For years now, populism has been steadily rising across the continent, driven by disillusioned voters who feel that traditional political and economic strategies are no longer working in their favor. Take a closer look at countries like Italy and France, where nationalist rhetoric is increasing and right-wing parties are gradually gaining support. The Giorgia Meloni government in Italy, various far-right factions in France, and growing nationalist sentiment across Eastern Europe reflect the reality that ordinary citizens are growing weary of policy failures, particularly those surrounding economic stagnation and global competitiveness. If tariffs worsen domestic inflation or provoke retaliatory measures, the very citizens that these policies were designed to protect will suffer the brunt of those consequences. Higher prices for vehicles and other goods might push lower and middle-income families deeper into financial strain, further fueling dissatisfaction with the EU political architecture. The EU has long been blamed for policies seen as benefiting elites while marginalizing small business owners, workers, and public services. We only need to look at the Yellow Vest movement in France to see how economic hardship triggers not just protest but destabilizing unrest. Worsening trade tensions could serve as the spark that ignites various factions of European society, still reeling from the long aftermath of the pandemic, high inflation, and economic uncertainty. Herein lies an even more pressing problem. Europe itself is divided on the issue of a common competitive policy. We have EU member states that are heavily reliant on exports to China. For instance, Germany and Spain heavily trade with China in both automotive and agricultural products like pork and dairy. How will these countries respond if tariffs escalate into a tit-for-tat trade war? The potential for internal bickering is high, and this might even stall efforts to forge a unified economic strategy for the continent. As German Economic Minister Robert Habeck aptly put it, "Together Europe is strong. Divided, it becomes a pawn of others." What happens when member states no longer see eye to eye on key economic and geopolitical threats? So where does this leave Europe, China, and the world economy? We've outlined several critical issues cropping out from this escalating trade war. The EU-China tariff battle is symptomatic of deeper structural weaknesses within Europe, not just a temporary knee-jerk reaction to unfair competition. European automakers, among the continent's industrial backbones, have been losing competitiveness, and tariffs on Chinese EVs may only provide short-term relief while failing to solve the structural challenges. The backlash from China will have consequences, particularly in agriculture, manufacturing, and potentially even the financial markets. Europe's inflation problem is far from over, and protectionist measures could further exacerbate price pressures at a time when central banks are attempting to rein in wages and tighten monetary policy. This trade spat will ripple through the global economy in ways we could never fully anticipate. Between the return of stronger U.S. industrial policy, China's well-crafted Belt and Road expansion, and Europe's complex political fiscal strait, we have what is shaping up to be an economic environment most haven't prepared for. Now, my dear viewers, here's the real takeaway. This is not just an issue of tariffs. This is an issue of whether Europe can remain relevant in tomorrow's global economy. Europe must rethink its entire industrial strategy, not with more subsidies and tariffs, but with structural reforms, increased innovation incentives, and a solid recovery plan for its key industries that position it to compete head-to-head with technological giants. The EU needs a rapid transformation to avoid being crushed between an increasingly insular America and a relentlessly competitive China. Will it rise to the occasion? Only time will tell.